I am Jacob. On February 1st, the US released a series of important economic data. The US market manufacturing PMI final reading of 46.9 in January, the US ISM manufacturing PMI of 47.4 in January, a new low since May 2020. US ADP employment rose by 106,000 in January, the worst performance in a year. The poor data, coupled with the Fed's decision to raise interest rates by 25 basis points, led to a bearish market for the dollar, with the dollar index plunging to a new low for this correction. But what the market did not anticipate was that the next day after the US economic data put two super satellite. The data on February 3rd showed that the US non-farm payrolls increased by 517,000 in January, the largest increase since July last year. The unemployment rate was 3.4%, a 53-year low. Average hourly earnings rose 4.4% year over year. The labor force participation rate was 62.4%. The US ISM non-manufacturing PMI for January was 55.2, expected to be 50.4. The previous reading was revised from 49.6 to 49.2. The shocking reversal in US economic data was somewhat unexpected. Looking at the US economic data released on Friday alone, this set of data implies that the US economy is not only improving, but also overheating. Not only are the ADP employment numbers the opposite of the non-farm payrolls, but the sudden jump in the services PMI is also confusing to the market. It is obvious that the US is faking again, and its purpose is nothing but to stabilize the dollar. Wall Street financial capital is using the US economic data to maliciously manipulate the market. In the malicious guide market expectations, want to lure the international market into the trap of the Federal Reserve to continue to raise interest rates. This led to a big rise in the dollar index, a big fall in non-US currencies, a big rise in US bond yields, a big fall in gold and silver, and a retreat in US stocks this Friday. After peaking at the end of September last year, the dollar's extreme appreciation continued to decline sharply under the collective counterattack of non-US currencies, falling more than 12% to its low on February 2nd this year. The strong dollar has returned to a neutral dollar in just 19 weeks, and if it continues to fall, it will undoubtedly accelerate the global de-dollarization process. At the same time, US debtors will continue to sell US debt at high levels. Once the dollar's international map continues to shrink, the dollar's minting power will decline significantly. The dollar's international status will continue to decline. The United States still rely on what to pass on the debt crisis. If the dollar's international circulation channel is blocked, the US debt will not be distributed to the world. The US economy's external drainage system will be blocked, then the US huge debt problem will be its own problems, to rely more on the internal cycle to solve. But the growth rate of US debt has far exceeded the growth rate of the US economy, the US debt on what to support it. Only rely on money printing, the Federal Reserve will become the Bank of Japan. The end result is inflationary explosion. The most critical problem is that in the case of a relatively healthy external circulation of the dollar, the United States is able to pass on the risk of debt to the world through the economic crisis. Once the external circulation of the dollar has a major problem, the United States, when the outbreak of economic crisis and then printing money to save the market, it will form a crisis on top of a crisis, which will hit the dollar system and the US economy. Then the US economy is not just a hard landing problem, but a shock problem. At the moment, the United States wants to stabilize the dollar, but there is no effective way to stabilize the dollar, because the reverse globalization has caused the debtors to flee. So there is only falsification of data, using the international financial discourse for fraud. The United States also knows that this is the time of rights. If these methods do not achieve the purpose, the United States will have to use more radical means to create a global economic crisis, in addition to no longer find a better way back. This week, after the Federal Reserve announced a 25 basis point rate hike, the ECB and the BOE raised rates by 50 basis points on February 2nd, mainly because inflationary pressures in the Eurozone and the UK remain relatively high. Since the current round of rate hikes, the ECB has raised rates sharply for the fifth consecutive time. The key interest rate has risen to 2.5%, the highest level since 2008. The Eurozone economy is currently weak, but high inflationary pressures have forced the ECB to raise interest rates sharply. Data showed that the Eurozone inflation rate was 8.5% in January. Although the third consecutive month of decline, but the overall remains at a high level, and inflation target is far from the ECB's monetary policy currently remains committed to inflation as the target. From the point of view of inflation in the euro area, the ECB's journey to raise interest rates is expected to remain for 2 or 3 months. The termination of the rate hike is expected to be later than the Federal Reserve. The current main problem in the Eurozone is not only high inflation, but also the return of asset bubbles. The major stock markets in the advanced European economies are currently performing strongly, and major stock indices such as Germany and France are approaching new record highs, with a higher probability of breaking through the historic highs. In the case of the ECB and BOE aggressive interest rate hikes and economic downturn, but the major European stock markets are back to super bull market, which will bring more risk to the European market. Although European stock markets have attracted international investors due to factors such as the sharp depreciation of the exchange rate last year, the re-expansion of asset bubbles is undoubtedly dangerous for Europe. Because asset bubbles will further stimulate inflation once the Federal Reserve's monetary policy late early dovish turn, the European financial markets exposure will be significantly expanded. With the current upward trend of European stock markets, the risk of international financial markets in the second half of the year is very high. The high degree of financialization has made the US and Europe a vampire of the global economy, which is not without its side effects, one of the main side effects being asset bubbles. If the stock market and other risky assets continue to fall, the US and European economies are bound to have big problems, and the risks of the US and European bond markets will be fully exposed. Therefore, the US and European stock markets have become too big to fail assets, and the financial markets have become monetary black holes. From the point of view of the financial markets of the United States and Europe is a process of constantly brewing superstorm. Extremely with the monetary bubble constantly maintain a super financial bubble burst. If the US and Europe's asset bubble does not burst, the burst will be a historic disaster. It's the end of this video. Thank you for watching. Please subscribe to support me. See you next time.